Folks, thank you for joining us again for another episode of Real Estate Investment Real Talk. And today we have a special guest with us, Steve Thibodeau, who is basically certified, personal accountant, CPA, and he basically has a lot of experience in accounting and setting up the corporations and helping people doing taxes. So Steve is really very knowledgeable and he's been in this business for over 20 years. So I have asked Steve today to join us and give us some understanding on different questions. Folks ask me and ask you about corporations and whatnot. So today we are going to focus on what is the right corporation for each entity type and what are the pros and cons. And then we will talk about real estate investment trust, and then we may talk about will and estate planning and other things only in the realm of accounting, not in the legal side. So in any way, without further ado, let me welcome you, Steve, and ask you a few questions. But before that, would you like to add more into the intro, because I really didn't pay too much attention to explaining all of your skills and experience.
Yeah, sure. So my name's Steve Thibodeau. I'm the managing partner at O'Connor Maloney and Company in Worcester, Mass. I've been actually in the practice for 25 years. I've been here at O'Connor Maloney over coming up on 23 years. And I do have a lot of experience in corporate tax as well as other consulting. We have a large number of real estate clients in our practice. Some of the larger real estate holders in Worcester County. So we do have a lot of experience in this realm. I will, full disclosure, Rashid kind of touched on it, but I am a CPA, not an attorney. So all this is really limited to more the tax side. I'll give you a little bit of insight on the legal side, but don't take it 100% at value. It's enough to maybe have you ask more questions to your attorney, making sure you're doing everything to the letter of the law. And part of this discussion is really around the liability side of things and what makes sense, as well as the tax side of things. So really to give you more knowledge, I wouldn't take everything from here and run with it 100%, but at least to ask more questions, as this podcast is really for.
Okay, Steve, thank you very much. Thank you for the clarification. We appreciate it. But first of all, let me understand, Steve, there are a lot of people who I deal with, and they have, different businesses. Some of those are like doctors or engineers and professionals, and they have the side business, some other passive income. So they always ask the question, do they really take the money as 1099 and put that in their regular income, or do they really set up a separate corporation? So certainly there are pros and cons of setting up different type of corporations. So if somebody is dealing with a small business, Steve, and whether or not they have W-2, there are different type of corporations, and the main ones are really C, LLC, S corporation. And what other corporation would you think of, Steve? And then if you want to really shed light, how should somebody decide between S versus C, and then S versus LLC?
Okay. Yeah, let's so on, if I don't know if so really depends on how much of activity you're going to have going on. Now, you mentioned physicians. We have a lot of physicians that they'll do consulting on the side. They'll get 1099 for giving lectures around the country, or for different consulting.
They may have a real estate portfolio as well on the side.
Well, yes, Rashid, I was going to get into that. So they'll file Schedule C if they have, ordinary income would generate a Schedule C inside of their personal return if they don't set something else up. Or they may have, a lot of physicians will have real estate for, on the side for investments and whatnot. And that would generate passive income, and that would require a Schedule E if they, do not incorporate any other kind of corporation or LLC or anything like that. So that would fall inside their personal tax return, and there's no additional protection because there's no other entity that's been created to shelter them from any of that. But it would fall inside a personal tax return, and they would, there's no extra forms or tax returns to file. Besides actually there would be none.
So, what would you really choose between C and S? What would trigger somebody to go with S or LLC? And then I'm going to ask you the difference really between S and LLC.
Okay,
then,
so let's just to clarify, C corps, regular corporations, and S corps are very rarely used in the real estate realm. And one of the major reasons is, the taxation, not so much the taxation of it, because it passes through to the individual just like a partnership would on an S corporation. On a regular C corporation, we can just talk about the structure of that real quick. So you have shares of the stock, everything, all your income is picked. If there's income, it's picked up inside the corporation, the C corp. And the corporation will pay all the tax. It doesn't pass on to the individual. The corporation is 100% liable for that tax. Now, what's the downside of a C corporation is that the income is stuck in there. Now, we pay a tax on the income in there, and now we say we want our money out, right? So we made $100,000, and we have $100,000 profit in cash inside the business, and we say, hey, I want that money. That's my money. Well, now it's going to come out as a dividend, a qualified dividend. It's going to pass out to you, and you're going to pay 15, 20% to IRS on that distribution of income, distribution of past income of really retained earnings of the company into your personal return. And now the C corporation is where double taxation takes place.
So, Steve, let's just slow down here because that's a very, very key point. So, you're saying, first of all, in the C corporation, you are going to basically pay the taxes in the corporation, and then when the dividend comes, that becomes a regular income for you, correct?
It's also passive income because it's qualified dividends, which is investment income. Okay. So that can trigger passive income tax in your return as well. What's that?
That would be more like a 15%, like a dividend tax?
15 or 20%, yep, depending on, it could be 0% depending on your other income, but yeah, 0, 15, or 20, yep. It would be treated like a capital gain in that same tax realm, 15%.
So if somebody has S corporation, and then in the S corporation, all the earning go directly to you, so there's no tax event at the S corporation. The tax event will happen when you file your taxes, correct?
Correct. So an S corporation, you also have stock. You're the owner of the business. The net, I like to use $100,000 just because it's a nice round, decent sized number. $100,000. The business makes taxable income is $100,000. Yeah. Federally, you pay no tax at all. The state wise as well, depending on what state you're in. But there's just a minimum excise tax in some states. But yeah, all the taxable income passes through to the shareholder or shareholders, and the income is picked up on the individual tax return, and the individual will pay the tax itself.
This income is a dividend income or a regular income. So
the income that passes through to you on a K-1 it depends on the type of business it is. So if it's a business like a physician, it's ordinary income passes through to you. If it's real estate being held, it comes through as passive income. There's different lines on the K-1 to tell the tax return how to treat that taxable income. Now, you could have dividends, you could have other things like that. That all passes through to you. However, whatever type of income that is inside the business passes through to the owner to pick it up as tax on their personal return.
Okay. So basically, if somebody had a C corporation, they they will have a dividend, and that dividend will be at the dividend rate. But whereas if you're an S corporation, yes, it's no double taxation, but then that income could be treated as a regular income.
Okay,
You-
let's
and
just clarify.
yeah,
So you asked about how the income is taxed, and that's what I was covering there. So it passes through the individual to be taxed. Now that has nothing to do with whether the money stays inside the corporation or not. Now I think what we're trying to get at here is what happens on the distributions. Rashid, say you have an S corporation, you say I want that money. And the question is, what happens? What's that? Is that distribution taxable to the shareholder when they take it out of the company? And the answer is no. So whether you take the money out of the company or leave it in the company, the tax is the same to you, right? So you can leave that $100,000. You can leave that in there every single year. You make $100,000 for 5 years. Company has 500,000. You've paid the tax on that historically. And whether you take that money out or not over that 5 years, you're going to pick up $500,000 of income over the 5 years. And now you can take that money out. You can take that money out at any time, whether in the first year, in the 5th year. There's no tax when you take the money out of the company and put it in your personal bank account.
hang on. So I just want to clarify. We are talking about S corporation, and regardless of whether you're taking the money out or not, you have paid the taxes because that went to your Schedule K and that has gone into your personal tax, because you cannot complete your personal tax return until you complete that Schedule K if you have the S corporation, correct?
Right. So you have to file you have to file 1120S, the S corporation federal tax return. That K1 is generated for the shareholder.
Okay.
When you file your personal tax return, you report the K1 inside your personal tax return, just like you would report a W-2 or a 1099 interest or consolidated. It gets reported inside your tax return. You pay the tax personally on that income generated from the business.
Right. So that's the reason you said you can leave the money in S corporation or in the bank account, in that bank account, or you can take it. But since you have already paid the taxes, this is your money.
Right. And the reason I clarify that, and it's very important, a lot of people get confused. They're like, well, I didn't get the money out of the company, so I don't have to pay tax on the money. Yeah. And that's why I'm trying to be very, very clear that whether you take the money out or not, it's taxable to you.
Yes, because to complete your personal tax return, because it's a S corporation, it's a sole proprietor, you have to complete.
It's not a sole proprietor. Yeah, so you want to be clear.
Sorry,
it's not a sole proprietor.
But S stands for
small corporation.
Sorry, but you to complete your personal taxes, you have to, finish you have to file 1120 and get.
So your 1120S has to be filed first, and then from that you receive your tax form to pick up that income in your personal tax return.
Okay, and then the deadline usually for S corporation to file that 1120S is usually March 15th, like a month before.
That's the original filing date. It's March 15th, correct?
Okay, so the reason, even though you don't have to pay taxes there, but you have to file 1120S on March 15, even though you have till April 15 to do your taxes for your personal income, and the money is going to come to your personal income, and the tax is going to be paid then, correct?
Correct. Yep. Correct.
But then you do have to pay the state fee, the 450 or 495. How much is that state fee if you have S corporation?
Excise in Massachusetts, where we're based, is $456 for the excise tax. It can be more if you have over $175,000 of overall value, and then it goes over 456 because it's a calculation just like your vehicle excise tax. It's based on value, but your minimum is 456.
Okay, great. And now the other question there is that in S corporation versus LLC. Mm-hmm. So now when you have the LLC, before we go to LLC, let's just clarify and finish the C corporation. But when you are in the C corporation, you actually have to pay those taxes by March 15 because it's a totally separate entity, and then the money could stay in C corporation or come back, but the taxes have to be paid with filing the C corporation by March 15, correct?
To clarify, a regular corporation, we're referring to a C corporation, but they're just regular corporations. Their due date is April 15th, so you have an extra month. And to clarify,
15. Okay.
yeah, so it's 4/15, just like individuals. And yes, the tax would be due on April 15th for the business. And again, to clarify, just one more clarification is if the money stays inside the company, you just pay the income tax. And then say 5 years down the road, you decide you want to take the money out. That's when the taxation of the dividend would take place in the year that you take money out of the company. And that would be a qualified dividend.
Well, you pay the corporate tax when you file every year, but when you take the dividend, that's a second event. That's what
Right.
double taxation.
That's where the double taxation comes. Yep.
That's the second event. Now you took that money and you have to, you have to record that in your taxes, and now that would be your dividend money.
Correct.
Okay. And that could be your regular income as well if you're taking it as a salary, correct?
No. So corporation. So the corporation, I mean, S Corp or C Corp, if it's an ordinary business, ordinary trade and business, you're supposed to be paying yourself wages through payroll and all that. This dividend out of the business, it's investment income. It's residual income out of the business that you're taking out. Just like Apple, if you get dividends from Apple or IBM or any big company, those are regular corporations, obviously much bigger. But the taxation of that is just like owning stock in one of those companies.
Okay, but in both C and S, you're supposed to take, if you have decent amount of money, you're supposed to take the income as wages, your personal wages.
If it's an ordinary trade or business, yes. Then if it's passive income, you're not allowed to pay yourself a wage off of real estate activity on any level.
Okay, great. So now when you go to S corporation versus LLC, now help me understand, a lot of people are confused between LLC and S corporation. What is the pros and cons, or is it really the same thing for one person?
So the answer is maybe. So I did watch your prior podcast about this, and I want to be clear to clarify some things here. You can actually make an election with an LLC to be treated as a corporation, and from there you can make an election. And therefore, on the initial election, you're treated as a C corp, and then you can make a second election to be treated as an S corp. So that's why it's maybe. You can actually make an LLC or any type of corporation that you want. So,
Nice.
But that's just to be clear. That's to be fully clear on that. Now, what you're talking about, I'd like to one other clarification. An LLC can be a single member LLC, which is just you're the only owner, and I think that's what we're going to get at here. But you can also have an LLC can also be a partnership. So you have more than one owner. It becomes a partnership return. We file a 1065, and a K1 is generated, just like it would be for an S corporation. Okay, so just a little more clarification there. Now, an LLC, and now that's obviously there's rules around the LLC. So let's talk about single member LLCs, which I think is what we want to get here. Some clarification around the LLC. You want your own bank account. You want all activity to run through that bank account. That's what's going to create the LLC. Give the LLC your protection, right? If you just ignore the LLC and run everything through your personal bank account, and something happens, that LLC can be challenged, and it's called piercing the corporate shield, and your assets may not be protected in a lawsuit. Now, again, I'm a CPA, not an attorney, just enough to be dangerous and give you a little insight. Okay, so now. Single member LLC versus an S corporation. Let's focus on that. Single member LLC gets reported right inside your personal tax return. There's no separate filing. There's no 1065. There's no 1120S. if you're a single member LLC and you don't make any elections. So just
So
as if
hang
it
on a
doesn't
second.
exist.
Hang on a second. So if you had S corporation, you had to file the taxes, which is the 1120S, by March 15, and you file your. Then all the money comes to you, and if you elect to take, it doesn't matter. But the money actually, the tax event happened when you file your taxes on April 15. You're saying if you had LLC, you don't have to file something like 1120S. So how do you? So basically, that is one less paperwork, and you do have.
Yeah. So a single member LLC is considered a disregarded entity, and what that means is we don't that it's disregarded for other tax filing purposes. It falls right in your personal tax return, just like it doesn't exist. So as if you own the real estate in your name, right? So that would when I started about rental properties. Schedule E right inside your personal tax return. So the single member LLC would be reported in the same exact way as if it doesn't exist. If falls in there, it's all within your personal tax return.
So then, does it even offer any protection?
Of course, it offers protection. That's why the LLC exists. That's why I just said about the bank account and treating
Yeah.
everything separately.
Right.
That's where the protection comes in, because it's a shelter for liability purposes, right? LLC, we know, means limited liability company, right?
Yeah.
So the LLC does own it for liability purposes, but because it's a single member LLC, it falls inside your personal tax return, and so the tax is paid at your personal tax return levels, and it falls under the same tax rules for passive activity as if it didn't exist.
So I'm kind of still not clear on the pros and cons of LLC versus S corporation. I mean, it seems to me LLC may be even simpler than S corporation then, because you don't have to do 1120S.
1,000%. Yeah, I agree with that statement. There's something else I'd like to talk about real quick about difference between LLC and corporations. Okay, whether you're an LLC single member or LLC partnership, there's something called, when someone passes away, there's something called a step up in basis, and it's an estate rule, right? So say you bought a property for $250,000, and then someone passes away and it's worth $1 million. There's a $750,000 difference in valuation there. Well, upon death, whoever receives that property through inheritance or whatever now receive it at $1 million. Well, what happens if it's an S corporation or a regular corporation? The valuation is stuck in the stock. So your stock receives a step up in basis, but not the properties. Now, that's a big difference for future tax purposes, because if your stock increases in value, but then you go sell the property is going to be taxed on all the gain, right? Because you're not, unless you sell the stock. Now, over here, if it's in an LLC, if it's a partnership, you can take a 754 election step up. So it increases in value. You can sell that property and you pay no tax on it. So where if it's stuck in an S corporation or a C corp, if you just sell the property within the company, you're going to pay full tax. So you have $750,000 gain for whoever inherits that stock if they don't sell the stock and they just sell the building itself.
I think this is a very, very important point, and I want to hash a little more into it, but we already at the 25 minutes mark. We're going to stop here, Steve, because we don't want to bore people, and I would request you maybe 1, 2, or 3 more sessions to understand this a little further if you have time. But I think there are a lot of learning here, a lot of learning for me, for sure. So I hope you come back and we do another show on that.
Okay, sounds good.
Yeah, so folks, we will be talking more in detail and other pros and cons between S and LLC, And then definitely I have more questions. And then also I want to touch base a little bit about real estate investment trust, our real estate trust. I understand that that's a very tedious topic, but we may take 2-3 sessions and see whatever you're comfortable with. And until then, everybody have a happy, healthy life. Thank you.